Mart, thank you very much for joining us today. How are things in Amsterdam?
Thank you for having me. Things are great over here. I've been extremely busy since WNA last month. We got to catch up there, which was great. But no, things are going well.
Well, this is one of the reasons why I thought you and I should sit down now and have a discussion on what's happening within the nuclear energy space and the uranium space. There is a lot of news, and I think the big news that has come out here in the last month or so is big tech entering this sector. And the first deal that was announced was this deal between Microsoft and Constellation Energy, and that really ignited the whole sector. And so I want you to expand on this, and maybe you can just tell us the highlights of this deal and why investors should be aware of what's happening within this sector.
Well, the deal is absolutely massive. It shouldn't really be understated how much impact this deal has, not just for Constellation Energy and Microsoft itself, but for the entire nuclear power sector. Because for those who have not read the details about the deal, basically Microsoft went to Constellation Energy saying, "Hey guys, we want you to restart one of the Three Mile Island units." And I know a lot of people, when they hear about Three Mile Island, the first thing that springs to mind is the accident that happened there. But a lot of people don't know that one of the units actually ran all the way through to 2019. It was then shut off due to economic reasons. And now Microsoft has come back and has offered Constellation Energy a big premium on their power purchase agreement. So they are willing to pay $100 to $110 per megawatt hour. And that is as I just mentioned, a significant premium compared to what usual US power prices are priced at for megawatt hours, which is just around $40. Some are less, some are more, but if you say 40, 45, I think that's a pretty good ballpark. So they pay over double when it comes to that premium. And why? Well, because Microsoft, just like all these other tech giants, they are looking for clean, sustainable, and reliable, that especially the last part, reliable energy. So if you look at the unit that they want to restart, in the last year of operation in 2019, it actually clocked in a 96.3% capacity factor, which is exactly what you want to see if you're going to run a gigawatt scale nuclear power plant on it. So this massive deal coming down to roughly $16 billion it's massive. And you saw that in the share price of Constellation Energy as well. It was up over 20% in just a single day. And I think that really speaks to the way that the market is viewing nuclear right now. I know from a few people that have told me that the Constellation, that the board was sort of hesitant when it comes to restarting a nuclear power plant, especially because of the emotional weight that is related to Three Mile Island. But looking at it right now, looking at the share price reaction and looking at the way that nuclear power is viewed by the public, politics, and also large financial institutions, it is clear that we are firmly in an upward trajectory for when it comes to nuclear power. So basically what you're looking at right now is you have Microsoft buying 835 megawatts of power from Constellation Energy with that high capacity factor. And they're doing this because they want to power their data center infrastructure that they have in the state. But it doesn't stop there. Like this entire trend of AI becoming a uranium play, if you want to call it, I don't know if I would call it that, but it is undeniable that the space race, if you want to call it that, the space race between companies and countries to really develop AI to the best of their abilities. You're going to need a lot of data centers for that, and that is very good for nuclear power, which in turn is very good for uranium. So if you look at the numbers by 2030, it's expected that the world will have around a need of 500 to 600 terawatt hours of data center demand, which is around 63.5 to 76.2 gigawatts of nuclear power capacity, assuming a 90% capacity factor. And they will need this for machine learning, for AI growth, for 5G services, everything. So that would account for approximately 3 to 4% of global electricity consumption. And that is just significant. Like this is a trend that is not going to stop anytime soon now that it has been set in motion. And you have people like OpenAI, Sam Altman, going to the White House and telling them, hey guys, we are probably going to be seeing gigawatt scale data centers that will need to be powered. And spoiler alert, such a critical piece of AI infrastructure, you're not going to power that by wind and solar with a 15 to 35%, depending on where you place those, capacity factor. You need reliable, clean power, and because these tech giants also care about the ESG rating, they also need to have that power be green. So no coal power. I think some of these data centers will absolutely be powered by gas as well in the transition period, which is good for gas demand. But in general, they are going for the nuclear power demand. So you not only have Microsoft with this massive deal between them and Constellation Energy, you also have Google signing an SMR agreement for 500 megawatts with Kairos Power. You have Amazon signing a massive deal with X Energy for 5 gigawatts and a $500 million investment in X Energy. And also Amazon will be exploring SMR capacity potential with Energy Northwest, trying to build 4 small reactors with them. And they're targeting to bring, I believe, as I just mentioned, 5 gigawatts by 2039. You have Oracle, which is also a tech giant, wanting to build more SMRs, or actually wanting to build a bunch of SMRs for their gigawatt scale capacity reactors. You have Meta's, previously Facebook's management, as well as Nvidia's management, coming out in support of nuclear power for, again, an AI space race. All these companies, they want to front run what is a trend that will likely define the coming decades. And that requires a lot of nuclear power. So it has firmly come back into the fray, and 3 Mile Island is not and will not be the only reactor to be restarted. You also have the Palisades nuclear power plant is being restarted. You have Next Era Energy recently coming out and saying, hey guys, we have this shut down nuclear power plant called the Duane Arnold plant. We are very interested in bringing that back because there is plenty of demand for it, because these tech giants are willing to pay a fat premium with a 20-year-long PPA, and that just builds in a lot of certainty for them and a lot of cash flow. So if you consider this, I think that we will see a lot more positive news for nuclear power going forward. You have the energy secretary in the US at the opening of the Vogel plant saying that we have 2 down and 198 more to go. She's not just saying that to sound witty. She's saying that because there is so much support right now for nuclear power.
And Mart, let's talk about 3 Mile Island now. You said the reactor has been shut down since 2019. When is this expected to be up and running again?
If everything goes well, it is expected to be up and running again in September of 2028. So Constellation just announced that they were purchasing a $100 million transformer unit that they will be using to make sure that the reactor, when it gets up and running again, will be all up to snuff, as they call it. And it should run then for another 20 years. Could it run for longer than that? That remains to be seen. But the power purchase agreement signed with Microsoft will be for 20 years.
2028. I might be dead by then. Why is it taking so long?
It takes a long time to restart these units, and they need to jump through a bunch of regulatory hurdles. They need to make sure that the reactor is completely up to date when it comes to safety features, when it comes to being able to supply reliable power for 20 years. Like, these things are not turned off and turned on like a light switch. Like, these are very complex units, and so it takes some time to get all the approvals, get all the necessary material, and make sure that they can then operate securely and safely for 20 years.
So that's a good overview of what's happening with big tech and nuclear. I want to move on now and ask you about Kazatomprom. There's always news coming out of Kazatomprom. It's the world's single largest uranium producer. They produce approximately 25% of global production. And they recently announced a deal with China. What can you tell us about this deal?
Well, the deal with was specifically with CNUC, and the reason that the deal got so much attention because they needed to get approval from their board, which means that, as they note themselves as well, that the deal itself entails 50% or at least 50% of the total book value of their assets, which means that this is once again a massive deal, and this is the third type of that at least 50% of total book value of assets deal that they've signed with China over the past 2 years. So these 3 massive deals, they kind of show that there is so much demand coming from China for these Kazakh pounds, and I don't blame them. Like we just discussed, the fact that they are building 31 reactors right now and aiming for 150 gigawatts of nuclear power capacity by 2035. So they want all the pounds that they can get their hands on. And it's kind of funny when I discuss this with people, when I discuss like the Chinese demand profile as well as their inventory. And it's often thrown into the mix as sort of like a bear case, because China has, depending on who you speak to and depending on the numbers that you use, between 400 and 600 million or more pounds of uranium in strategic inventory. And that may seem like a lot, but if you consider their 150 gigawatt reactor capacity they want to head out for 2035, it's actually not that much when you consider that they have a multi-decade view of energy. So building in that energy security, they will stay in the market. They will be buyers for years to come into the end of this decade. And this has been reflected by purchase volumes from Kazakhstan as well. So around, I believe, 37% in the first half of this year, 37% was China for supply volumes coming out of Kazakhstan. So that tells you all you need to know with regards to more and more pounds stake in the East. And I think that this deal, once again, it reflects the fact that China is looking for more pounds, and that Kazatomprom and Kazakhstan are more than happy to sign agreements with them for collaboration to ensure that they can deliver the pounds to China.
And so once again, we don't know anything about the terms, pricing, pounds, none of that.
No, sadly not. That is something that is done with a lot of NDAs attached to it, and it's not something that they just throw out in a news release or an interview. So they're very strict on that, and that's of course understandable. But what we do know is that it is a significant deal, and it just further encompasses the continued bifurcation in this market.
So I guess this begs the question, what does this mean for Western fuel buyers?
For Western fuel buyers, well, for Western fuel buyers that have been relying on Kazakhstan to kind of enact the proverbial bear case, we just discussed one of the bear case that is often touted being Chinese strategic inventories. One of the other bear cases that is often touted is, or was often touted because it's kind of dead and buried right now, is Kazakhstan really flooding the market, really ramping up the spigots and going to X number of millions of pounds a year to really flood the market. But not only won't they do this because they've really been going for this value over volume strategy for several years now, they also can't because of the sulfuric acid issues and because of the fact that their older, better assets are getting slowly and surely they're getting older, so they're getting less efficient. And their newer assets could, like, for example, Bunovska has higher carbonate levels, like the depths need to be taken into account of these new levels, and it needs more sulfuric acid, which is definitely something to take into account. So they will be building a new sulfuric acid plant that should be coming in around 27, maybe 28, but let's say 2027 right now. And when it comes online, it will supply them with adequate sulfuric acid to run their operations. But for Western utilities that were expecting a massive, massive ramp up of these assets, I gotta say that they have been in for a surprise. And from what I've heard as well at the WNA, is that several Western utilities have been left relatively frustrated, let's call it that, by the lack of real big new supply that was available for the West. Availability is a very important part of this equation because, again, as I just mentioned, a lot of pounds will be going to Russia and China. Basically, what we've seen in the meantime is Western utilities not really committing to a lot of new long-term contracting and kind of what I've been calling over the past month kind of pulling levers. So what they've been doing to buy themselves time, for example, let's say you've done a lot of due diligence in any particular equity. Let's say you've done half your due diligence at $65. It then runs to 106. You're not going to chase because you didn't finish your due diligence and you're trying not to FOMO in. Then you continue due diligence while it pulls back to $80 right now. And if it stays relatively stable there, you become more and more interested because even though you started your due diligence at 65, it's 80 is still a lot less than 106. So basically we saw for the price of uranium, we saw the price go up to the 106, then pull back to around $80. It has been a very, very strong floor ever since. And basically what we've seen is these Western utilities, they do not like these volatile price movements. They do not like the uncertainty that comes with the Russian import ban. They do not like uncertainty with regards to other supply dynamics that we're seeing right now. So they kind of pull back and they started pulling these supply levers to buy themselves time. They started to pull forward Russian enrichment. They started to pull in Chinese EUP, not by enormous amounts, and it's kind of dropping right now, but they did imports of Chinese EUP. They started drawing down available inventories if they had excessive inventories. They started, and that's perhaps the most important one, they started flexing up contracts. So if you have a contract for, say, £5 million, and you sign it at $45, you're not going to sign a new contract. If you have a 20% flex option, you're going to flex that up to the maximum of that contract's ability, and you're going to take that delivery at a lower price than what we're seeing right now. So after all those levers have been pulled over the past, let's call it the past year and a half, maybe 2 years, ever since the 2022 conflict between Ukraine and Russia, that's when kind of like the pulling forward of material started. I think it's very important to consider the fact that these levers are running out. And the fact that these levers are running out means that they will need to come to the market sooner rather than later. So we are at 80 million pounds of term contracting volume this year. Another 27 million pounds of that was added just last week. So it's been a relatively quiet year so far. It's also been a relatively quiet year in the spot market with 36 million pounds year to date being transacted. And with a few months in Q3 being some of the quietest months we've seen since the bear market lows in 2016. So what we're seeing right now is that term market activity is slowly but surely picking up. Off-market discussions are increasing. There are a few significant RFPs in the market right now. And what we're seeing is that we're probably not going to get to replacement rate contract this year. I think if we get to 120 million, maybe 130 million pounds this year, that would already be very, very good. If a large entity stepped in, we could get to replacement rate contracting if it really pushes, but that's not my base case scenario. But I do think we will see that next year.
And what's replacement?
Replacement rate is around 180 to 190 million pounds, basically the burn rate of reactors worldwide.
And right now we're at 80 million pounds.
We're right now at 80 million pounds. Yeah, last year we were at around 161, I believe. But there should be a big caveat on that, because 40.1 million pounds of those 160 million pounds were from the deal between Cameco and Ukraine's Energoatom. And then another 27.2 million pounds were added to that contract as an additional option to supply the Zaporizhzhia nuclear power plant, which is of course the largest nuclear power plant in Europe. And if that gets back in the hands of Energoatom and they can run that without a problem, those 27.2 million pounds will be added as an additional option in that contract. So that kind of skewed the numbers a little bit, but looking at the way that contracts are being signed right now and what is being negotiated for, we are looking at floors of $75 to $80 and rising. We're looking at ceilings of $135 and rising. We're looking at some market reference contracts without ceiling at all. And of course, that should absolutely be noted, every single contract is unique. Not every contract that is signed from now on will have a ceiling of $135 or a floor of $80. Every contract is different. It will have different bells and whistles. And I think that the most important thing to consider is that as we get closer and closer to the replacement rate contracting next year, volumes are increasing, timelines are increasing into the end of the 2030s, and we are firmly getting into a seller's market right now. So I spoke to the various producers at the WNA, and basically what it came down to is that they have, for the first time in many, many years, their cards are in their hands. It's a seller's market. It's becoming more and more of a seller's market. And all these bells and whistles, like these flex options that were in previous contracts that were signed over the past decade, those flex options are nearly fully gone right now in new contracts, and terms are becoming more and more favored For suppliers, again, every contract is different, every utility is different, every producer is different, but in general, it's a seller's market and terms are becoming more and more favorable for producers. So long story short, I think that we are in for a big contracting cycle. In the last bull market, the majority of the price discovery came in those 3 to 4 years where we saw replacement rate contracting of between 110 to 130% of replacement rate contracting. And that was paired with a lot of upward price pressure. And I think we will see exactly the same starting next year.
So I got to ask you about the spot price because it is down on the year and it's trading in the low 80s. I think it's down around 10% on the year, but we just went through this demand scenario and we got all this big future demand coming from big tech. China has this massive build out going on between now and 2035. And yet supply continues to be very tepid. Kazakhstan has ongoing issues. We have ramp up issues coming out of Paladin and also Boss Energy. We still have these issues going on in Niger. So why isn't the spot price significantly higher?
Well, basically because the spot price is not exactly the right metric to gauge this market by, because it gets
Okay, then
moved.
the question, let me ask it, why isn't the term price significantly higher?
The term price is significantly higher. It's 70% higher year to date, approximately. On that calculation was made back when it was around 53 million pounds being signed into term, and like 17%. It may not seem like a lot, but that is absolutely significant, because 17% on what is seen by a lot of people as not a lot of volume, which it isn't a lot of volume in the grand scheme of things. That tells you that the market is really tight, and when real term market volumes come in, that the price is going to be a lot higher. So I think that is a very positive sign. I mean, we've not seen, like, people are constantly saying that the term price is not really moving, but it has not had a single month-over-month decline of greater than $1 for, I believe, 3 years now. And it is been on a consistent upward trajectory, and that is not changing. I mean, if we would be in the third year of replacement rate contracting right now, I would probably tell you that there is not a lot of upside left on the term price, maybe a little bit as the final contracts get inked, but we have not even seen a single year of replacement rate contracting. And again, that is when the majority of this price discovery happens. So more people should be focused on the term market and the moves that this is making with that continued steady upward trajectory, because the spot market is just going to drive you crazy. I mean, like, for God's sake, like last week with the spot market, it dropped $2 on a single transaction taking place. Earlier this year, we saw the spot market drop $3.50 on no transactions taking place. That is a ridiculously volatile and not a very accurate representation of the market. Of course, I'm not going to sit here and deny that it has no function at all. Of course, it has a function in this market. It has various functions even. And of course, a lot of investors will be watching it, but the term price is the most important price to watch. Spot price, again, it serves its purpose. It has its function in this market, and it will continue to serve various purposes. But it is very volatile. And as you mentioned, like, it went up to 106, then it went down to 80, then it kind of chopped around a bit. And there are various parties that are very, very interested in buying the uranium if it gets anywhere close to around that $80 level, not just traders, but also utilities. I know the Chinese are interested in buying more pounds. I know some producers are interested in buying more pounds. I know some entities that are looking to put up a carry trade if the spot market diverges enough from the term market, and they can skim like a high enough percentage that it makes it worth their while to then carry that into a midterm contract of a utility. So yeah, the term price is still consistently ticking up. Spot price has done well, but it's not the main price to watch.
So let's talk about stock performance because I think this tells us a lot, right? And when I look at the stocks, they're not really doing that well given this positive backdrop. But when you look at the utilities, let's just say Constellation Energy, for example, which is the largest nuclear footprint in the US, it's up 150% on the year. But Kazakhstan, the largest uranium producer in the world, it's down on the year. Cameco, it's up 30% on the year. Much of that move came here in the last few weeks on the back of this Microsoft news. But why do you think the U.S. utilities are responding so much better than the actual uranium stocks?
I think that one of the things that really has to do with that is that that the market has clearly been looking for a way to play nuclear power. We've seen that with a few of these smaller cap nuclear tech plays, if you want to call it that, Lightbridge, ASP Isotopes, a few of those that we own as well. Like Lightbridge is up 180% since first entry. ASP is up over 200% since first entry. So those have done very well for us. But the uranium names themselves have relatively underperformed, especially these utility plays. And I think one of the reasons for that is that it's more of a tangible way for the market to play nuclear power and then to invest in, like you mentioned, Constellation Energy. They have the largest nuclear power footprint in the US, and it really it provides a way to play nuclear power for these large institutions. Because one thing that also helps, not only is it a play that comes to mind earlier, perhaps, than going for the fuel that powers set reactors. What you're looking at is Constellation Energy has a market cap of around $83 billion. That is 40% larger of the complete cumulative market cap of all publicly traded uranium companies. Like, they trade at, I believe, an average volume of around $910 million every single day. There is not a uranium company that comes close to that sort of liquidity. And so you have your chemicals and your spuds that are liquid on a relative basis, but it's very hard for large capital to play the nuclear theme outside of these larger equities. So I think that's one of the reasons that Constellation has done well. Of course, one of the other reasons is that they've been making money hand over fist, because everybody and their goldfish wants nuclear power. So they've been really able to capitalize a lot on that trend. I think beyond that, we are looking at, of course, like uranium equities have done well in space. Like, it's been very boom bust, and it's been very, very, very volatile over the past few years. We've had some big runs, we've had some big corrections, but if you could capture like these runs, like for example, after the WNA, sentiment was absolutely in the toilet, but it was clear that the market was going to go higher. That's also what the sentiment at the WNA was. So the discrepancy between sentiment at the WNA and sentiment from investors, especially on social media, that discrepancy was the biggest that I've ever seen. And I pressed my bid with call options at that point, and we had two positions in call options run well over 300% one in just a month and one in just a week. And that is basically the tail of the tape when it comes to these uranium equities. They are very volatile. They go up a lot, they go down a lot, but in general, the trend over the past 5 years has still been up. And I think that will continue, but again, not without a lot more volatility.
Mart, one of the reasons why I enjoy speaking with you is because you just don't follow uranium, you follow other sectors. And as an investor, I think this is very important, not to become fixated on one sector like uranium. And 2024 has been a great example of that. We have uranium down 10% on the year. Meanwhile, we have gold is up 30% on the year. But what other sectors are you following? What other sectors do you like right now?
Beyond these sectors, I focus on all the macro, because, like it or not, like, even despite how strong the fundamentals are for uranium, the macro environment has a big impact. But on specific sectors, you already mentioned a bit gold and silver. We at the Contrarian Codex went heavily long gold and silver equities in Q1 of this year. Those are up on average around 80 to 90%, so doubling SILJ, the silver junior mining ETF, returns year to date. And what we saw with, for example, compared to uranium, like uranium, just as an example, in 2021 had an amazing year. And in 2021, like some of these other resources, they didn't really follow up on that. So you need to have exposure to different equities as well. And that's what I do at the Contrarian Codex. So these gold and silver equities have done exceptionally well. I like cannabis as a soft commodity. I think there's a lot of tailwinds coming in with the rescheduling and more positive policy on the cannabis front in the US. Again, depends on what equity you pick, because like the general MSOS index is up like 2% on the year. That's pretty petty returns, but several equities are up 50 to 100%. You have copper, which of course, again, depends on the equity, but it has been doing relatively well. Tin has done very well for us. And I think that one of the sectors that that kind of right now gets overlooked is oil, and it gets absolutely hated, which I think is interesting as a contrarian, from a contrarian perspective, because it like you have the positioning, which is the most bearish in over a decade, and at the same time you have an enormous amount of geopolitical turmoil that only is escalating further and further. And I'm not saying that you need to make oil 50% of your portfolio, but I think that every single portfolio should hold a select few oil equities, even if you're not bullish on oil, even just for a call option as portfolio protection in case something happens on a geopolitical front. And beyond that, I think it's good to hold a healthy cash position. So we've been able to utilize a healthy cash position over the past month to really buy the dip on uranium in particular, and that has now been bolstered a bit after those call options ran so much. And I think that it is good to have a healthy cash position, especially as we enter the conclusion of I think will be a very, very pivotal election for the markets. And I think it will be extremely volatile. So please make sure that you have that healthy cash position. Make sure that you can handle the volatility. Watch out with short-term or very short-term options. Watch out with leverage. And make sure that with uranium, you have some dry powder left. Because I think that we are in for a generational 12 to 18 months.
Well, I hope you're right. Well, listen, that was a great conversation, and I want to thank you for spending time with us today. And if someone would like to follow you online, where can they go? And maybe you can tell us a little bit about your newsletter also, the Contrarian Codex.
They can find me on Twitter at yellowbull11, and they can find my work at patreon.com/Contrarian Codex, where I share a newsletter every 2 weeks. I share active buy and sell alerts, as we discussed. Those have done very well over the past year. I also do company analysis. I do various interviews with industry experts and analysts. And I also have a thriving Discord community that I'm very thankful of, where a lot of people with a lot of knowledge, it runs itself, which is great. I'm very, very thankful for the community that we have at the Codex. And there's a lot of people with a lot of knowledge and a lot of specific insights that have been sharing a lot of great information on there. So that is very great. And I hope to welcome people there.
Well, Mart, once again, thank you.
Thank you for having me.